Hey everybody, good morning and a brand new week to you. My name is Brent Moores, sitting in for Mr. Kevin Horner today, and glad to be here. Time to kick off the week. It's going to be an important week. Got a lot of stuff going this week, and we'll talk about that in just a minute. You can follow me on X, and you can follow Mike Fairborn on X. Mike is kind enough to help me out in the chat today. I always appreciate Mike. And let's see, at Brentmore CS, at Mike Fairborn CS. Mike and I have been working together a lot of years, and he's very knowledgeable in the markets. So make sure you join him in his webcasts, and you can always say hi to Mike in the chat as well there today. So let's go ahead and just talk about a few important disclosures here before we get started, and then we'll get to the main conversation today. The information today is for general informational purposes only and should not be considered an individual recommendation or personalized investment advice. And we'll look at specific securities today, but just realize we're using those to demonstrate things. They're not recommendations. We don't recommend any trades here. Let's see, short options can be assigned at any time up to expiration, regardless of in the money amount, even though I'm not planning on doing any options today. The paper money application is for educational purposes only. And let's see, Schwab does not recommend the use of technical analysis as a sole means of investment research. Past performance is no guarantee of future results. All investing involves risk, including the potential loss of principal. And there you go. Let's take a look at the markets to kick us off here today. This is the S&P X. We've just kind of had the open bell. We're down a little bit, which is actually looking a little bit better than the futures we're looking for a little while here. In fact, if I look at those futures just to kind of see, even if you don't want to trade futures, which is fine, and I'm not going to talk about trading futures today, sometimes if you want to see how things are doing after hours, you can look at futures. Here's the S&P 500 futures, the ES, and you can see how we've had a nice little jump in those futures here coming into the market open. We've seen this kind of repeated thing of late where we get some news where the market kind of sells off or doesn't really like the news necessarily, but then it recovers, and that's what we're seeing right here, right now, on that. So those are the S&P 500 futures. But let's just stick with the main index here today. So what's the news that kind of hurt the markets a little bit? Well, it was tariff news again. It seems like we can't seem to get out of that discussion right now. Over the weekend, President Trump announced 30% tariffs on Mexico and the EU. Now, leaders of the EU and Mexico, I believe, said they were going to continue to talk to President Trump and the team, so to speak, about trying to negotiate those tariffs. And those are due to kick in August 1st. So the market seems to be, shrugging it off, whether it's they don't think that's going to be the final tariff rate, or they believe, hey, ultimately the U.S. economy is strong enough to thrive even with the tariffs. That's something that we'll have to see on that. Let me just kind of show you something here, and that is these are the tariff rates. I tweeted this out a few days ago. I actually reposted it a few days ago. I said tweet. I guess that's the wrong terminology these days. This does not include the two that were announced this weekend, 30% on Mexico and the EU. But you can see the various rates along here. Some of the ones that were maybe a little bit more surprising were the Brazil tariff there at 50%. And let me think, was there anything else on here? Oh, the Canada tariff, which these were the news kind of towards the end of last week. So whether you're pro-tariff or anti-tariff, this is where it now stands. But it's important to note that whatever it is, it certainly can change between now and August first there. So let's take a look at the SPX here graph and see what we got. It's just been chugging along. This is a 20-day moving average. This is a 50-day moving average. Along the way, we've had support that we can see. We've had a trend, higher lows along the way. The kind of maybe going a little bit more sideways, but we've seen that before, haven't we? Okay. This has just been kind of go up and flag. This is what we mean when we say a flag pattern. Let me just clear this out just so you can see it. The market goes up and then it has a pullback. Okay. And this is in the context of an overall uptrend. This is what we call a bull flag. They don't always look exactly the same, and then it breaks out and then it creates a new flagpole. This is the flagpole I'm drawing right there, kind of sideways or down a little bit. And then some traders will look for the breakout above the upper line as a potential entry into a market. Okay, that's how it is. Now, if we break down below the lower line, break down below a moving average, that could be a sign for some traders to try and, reconsider their position. And when I say traders, let me just also emphasize, when I'm talking about traders entering on a bull flag, I'm mostly talking about shorter term traders, not necessarily longer term investors. This is Trader Talk, so a lot of times we focus a little bit more on some shorter term traders, but we also try and give you an overall view of the overall market right now. And that's what the trend of the S&P 500 has been looking like. Now, one concern sometimes people have when they look at this is the S&P 500 is not, it is 500 stocks, but it's not equally weighted. If you look at, say, the Visualize tab on Think or Swim Paper Money here, and you pull up the S&P 500, these are the 500 constituents of the S&P 500. Notice some are a lot bigger than others. The size of the rectangle or square represents the market cap of the company. So can you see how all these stocks that are in the material sector there, or the utility sector, or energy, or industrials, these are smaller companies. And the influence of each one of these on the overall index is market cap weighted. So that means if you take NVIDIA and Microsoft and Alphabet and Meta and Amazon, those are going to, and Apple, those are going to carry a much bigger weight and push that index a lot further. So sometimes what we'll try and do is we'll try and say, well, let's see overall, what about the breadth of the market? In other words, what about the overall number of stocks in the market going up or down? If you're on that Market Watch tab, of course, you can kind of visually see red or green. You can also go over here, click on Index Watch if you want, and you can see. Now, this is just for today, but we can see decliners, 281, advancers, 215. It's a moving number there to kind of give you a numerical value on that. However, one way that a lot of people like to do it, is you can either look at the S&P 500 equal weight, SPXEW, and see how this graph is. This graphs all 500 equally. Or another way that I like to look at things is to do this, is to go and do the $ SPXA50R, okay? Kind of a long symbol there, but this is telling us the percentage of companies above their 50-day moving average. Now, if you want to do a 100-day moving average, just switch 100 where it says 50 there. If you want to do 200-day moving average, switch 200 where it says 50 there. But this is the percent. It's come down a little bit, about 67, about 2/3 of companies are above their 50-day moving average. So it's showing some broad market participation there in the markets there. Now, let's look at some other indexes here. Let's look at the IndyX. Kind of a similar situation to the S&P 500. The NASDAQ tends to do better when the overall market is going well. It tends to outperform, I should say. Okay. So when the market is going up, the NASDAQ tends to outperform the S&P 500. And when the market is going down, the NASDAQ tends to underperform the S&P 500. Another kind of way of saying this is the NASDAQ tends to have higher beta stocks. A lot of you are familiar with the term beta. Beta is basically a measure of market volatility. A beta of 1 is kind of the benchmark. A beta of 1 means if you look at a stock statistically, historically, it's not a guarantee for the future, but historically, and typically we're looking back at a 1-year or 5-year period when we're talking about beta, we're saying historically it moves about the same as the S&P 500. So if the S&P 500 is going up, then the stock or whatever you're looking at is going to go up expected statistically about the same amount of the S&P 500. If the beta were 1.5, that would mean that the S&P that you'd expect that stock to go up about 50% more than the S&P 500 when it goes up. Or when the S&P 500 goes down, it goes down a little bit, about 50% more than the S&P 500 goes down. The NASDAQ tends to have higher beta stocks. So when the market is doing well, those tend to do better. Now, a lot of times what you may hear is maybe fund managers or companies or people, maybe your buddy saying, hey, I outperformed the market. I've done better than the market. And you're going, hey, very good. But I'll tell you this, it could be that they just have a portfolio full of high beta stocks when the market's going up. If you just load a portfolio up with high beta stocks and the market goes up, doesn't matter the stock, overall statistically, on average, you're going to do better than the overall market. That's not to say every individual stock will do better, and it's not to say you couldn't do worse, but on average, you'd expect to do better. Why? Because you're taking on more risk in that situation. So you need to look beyond just the beta of your portfolio or of a stock, just the performance of a stock, and consider things like the risk you're taking in your portfolio there. Okay, so that's just a point I want to make. Yes, the NASDAQ has looked mostly the same, but during this run, the NASDAQ has outperformed the S&P 500. And in fact, you can see that if we go from low to high on this graph, if we go from where our high was to our low was, come on, I need to just change my scale a little bit here. Let me just do this. Let me do this again. If I go from low to high there on the NASDAQ, about 39% gain. If I do that same thing on the SPX and go from, see how far we've gone, instead of 39%, it was up about 29%. Nothing to sneeze at, that 29% gain there, but NASDAQ has moved more. Now let's take a look at another area of the market, and that is not the NASDAQ. Let's look at small caps. Small caps have actually done fairly well lately. Small caps, if you were to rate the performance of small caps or measure the performance of small caps over the past few years, they've really underperformed pretty significantly. Part of that is concerns with small caps, smaller companies, lower capitalization companies, in other words, tend to have less cash on hand. They tend to be more debt dependent. So when interest rates are higher, their financing costs are higher. It tends to drag on small caps more. They tend to be more financially susceptible. And so they have underperformed. lately the market's had a lot of optimism. So actually small caps have done pretty well here. Let's do that same deal that we just did with the others, with the Russell 2000, and see what we got. Up about 31%. So they're doing at least as well, if not a little bit better of late than the S&P 500. So that's a change. That's a change in the market there that we've seen. Now, there's one other thing I just want to point out here is growth and value stocks. Let me just do this, and I have a growth and value style saved here. Let me just put this, let me just do this. Let's see. $SPX 500 PG. Okay, what did I do wrong? Hold on one sec here. Okay, one quick sec. Let me see. SP. Oh, not. Did I do S&P 500? $SP 500 PG. There we go. Okay, so this is a symbol you can use if you want. These are this just takes the 500 stocks in the S&P 500 and categorizes them as growth stocks or value stocks. Okay. Now, some stocks have characteristics of both. Okay. So not all growth indexes and all value indexes are the same. In fact, in some of these, the stocks, you have stocks that actually will fit in both the growth category and the value category at the same time. These indexes right here, the S&P 500 pure growth and the S&P 500 pure value, you just change the G for a V for a G at the end to get the value index. These are just the most growth and the most value out of those. So there's no overlap between the two lists. And you can see of late, growth has outperformed value. That's not always the case. Look, for a little while, here's growth in purple. It was actually underperforming. Okay. It was actually underperforming. So, and that historically, there's times of outperformance. There's times of underperformance. Let's get back to our beta discussion for a sec. Which tends to have a higher beta? Growth stocks tend to have the higher beta there. And so when the market is doing well, growth stocks tend to outperform on that. And of late, growth has outperformed there. So there's a lot of ways to break down the markets. Those are a few of them. Let's move on to some other things there. Let's talk about news, potential news this week coming ahead, and how it could potentially impact the markets. So what I want to do is I want to go, first of all, let's go to the economic calendar. This, by the way, is found on the Schwab.com website under research, and you can go to research tools or US markets. Okay. In fact, let me just show you how to get there. Click on US markets. This is the page you come up with. Scroll down to the right, you get economic. Okay. So here's this week. The big news this week, the things that can certainly affect the markets this week coming ahead are probably numero uno is CPI. That is an inflation report, and that doesn't just affect, that's not just inflation, that is potentially affects monetary policy. Okay, so keep that in mind. We've got PPI, Producer Price Index, coming up. Okay, those numbers are coming out on Wednesday. CPI Consumer Price Index, Producer Price Index. The theory is producer prices tend to lead consumer prices, but really, in terms of ones that are probably more likely to impact, it's hard to say. The one that's more likely to impact is probably the one that it differs from what's expected more. But this is a very important thing here that can certainly affect the market, the CPI. It's the first one that's coming out, and so it may have more of an impact than that PPI. Additionally, we've got building permits and housing starts, and I skipped retail sales, which is another important one. There's a lot of different reports. Most of them probably aren't going to affect the market that much. The ones I just mentioned are more likely for you to look, to impact the market there. Okay. Question in the chat: is there a possible is there a link for that growth versus value view? I don't have a link for that. I could share. Let's see. I guess I could share the chart. Maybe let me just think if I can do this. Does this? This is. I have this as a saved style, and you can't technically save. You can't technically share a style there. Okay. You can't technically share a style there. So I just did a comparison chart of the two, and I'm trying to think if I can share the chart, and I'm not sure how to do this particular chart here. So you can pull up these indexes, by the way, $SP 500 PG or $SP 500 PV as in Victor or value, if you want to see those. Okay. Now, one of the important things about that CPI report is this, is it can potentially affect what the Fed does. Okay, it can potentially affect what the Fed does. If inflation seems to be high, then the Fed is less likely to cut the short-term interest rates. Okay? And thank you, Paul. Let me just do this. And let me go. This shares that. You see, I forgot about that. Thank you, Paul. Let me share that chart. I'll put that for those of you who are in the chat here. I will put that in the chat, but you can always do this with those symbols if you're not watching live. There's a shared chart on this one. Okay. So let me go back here. So the higher inflation comes in, if inflation comes in hot, it's less likely that the Fed is going to cut interest rates, okay, short-term interest rates. If inflation is more stable, then it becomes more likely. This is the Fed Watch tool. This is just looking at Fed funds futures, and it's kind of extrapolating from those what the likelihood of a rate cut is for different time periods. This is looking at July, which is coming up at the end of the month. And right now, the way you read this is you go, well, look at the current rate's here, and this is the same. Okay, so it's saying 93% chance it's the same. In other words, it seems from this, it's not a guarantee, it seems from this that it's pretty unlikely the Fed is going to be cutting in June. Okay. Excuse me, in July. It's definitely not cutting in June. Now, if we go out to September, what you can see is it's a much more mixed picture. Now, let me show you later this year as well. So this is about 36%, according to the Fed Fund Futures, no cut, and one cut about 61%, with an outside chance of two cuts there. Okay. Now, if I go out further, go out to say December, then it changes significantly. This is a small chance of being at where it is right now. But I will tell you my view, my experience here from what I've seen lately is these Fed Fund futures, this CME Fed Watch tool has been very unreliable in terms of what it's saying versus actual interest rate cuts when you start to look out farther. Okay, when it's looking near term, for example, July coming up, I I think it's very likely that it seems like there's probably not going to be a cut in July. You never know. I don't know on this. But when you start to get to stuff like out in September or December, I think you're going to see these graphs change very much between now and then. So I wouldn't put too much reliance on there. So, but that can affect the market. In general, the kind of the conventional wisdom is if the Fed is cutting rates, it's probably going to help to boost the market. Now, there's a caveat to that, I would say. And that caveat is that if the Fed is cutting rates because of recession, that's probably not a good thing, right? The Fed could cut rates because they're comfortable with, the economy and inflation being in check, perhaps. They could cut rates for that reason. Another reason they could cut rates is a need to boost the economy. That's not such a good reason there, okay? And there's a lot of other economic factors that can influence that. Paul in the chat said jobs numbers could affect that. Yes, absolutely. If we get a terrible jobs number, and as a kind of a prelude to economic recession or economic turndown, that would tend to encourage the Fed to want to juice the economy a little bit with interest rate cuts. So we'll see. It's multifactorial, everybody. There's a lot of different things in there. Okay, now, so let's go and let me just go and talk about kind of a huge thing this week is earnings season. Earnings season. So let me click on Market Watch. I'm going to click on calendar. I have right here S&P 100. So this is not every stock. This is just S&P 100 stocks. But what we can see, July 15th. What's today? Today's the 14th. That means tomorrow morning, they just put 7 a.m. before market open, okay? Tomorrow morning, these are all the companies that are S&P. Keep in mind, I overdrew here. Okay, July 15th, July 15th, July 15th, July 15th, July 15th. These companies right here tomorrow morning are the ones that are going to be announcing their earnings. Okay, earnings season kicks off with financials is how we say that. So you get companies like Bank of New York Mellon, BlackRock, Citigroup, JP Morgan, Wells Fargo. Follow it up on Wednesday, Bank of America, Goldman Sachs. That's a financial. Johnson Johnson's not financial. Morgan Stanley. Okay, so those are financials. USB, financial. So huge. We're going to get a big glimpse of the beginning of earnings season and financials in particular kicking things off here. It's always interesting to see how they do. In particular, I would point out maybe JP Morgan, because a lot of people like to hear what Jamie Dimon says about things. He's a very influential CEO out there, and maybe the most, other than maybe Elon, maybe the most famous CEO out there. And people like to hear what he says too. So we'll see on that, but that could very well move the market this week, what earnings results are here coming up. Okay, let's look at some other charts. How's the market? How are you feeling about your investments, folks? Well, sometimes we can kind of get a measure of that with that. The VIX. VIX is at 18. It's jumped up a little bit. Let me just zoom in here a little bit. So feeling pretty good. VIX has jumped up to 18, or 17 right now. And that's a little higher than it was, but compared to where we've been, that means implied volatilities are a little bit low. Just kind of a reminder, and this isn't a discussion of options per se necessarily, but when we talk about implied volatilities, I think most options traders are more familiar with the term implied volatility, but a lot of you may not. Implied volatilities are a measure of basically options prices, okay? And so what does that have to do with fear and greed or uncertainty in the market, which is what the VIX tells us? And the correlation is this: the more expected volatility in the market, or what we call implied volatility, the more expected volatility in the market, the more expensive options are. So we could say implied volatilities, or the VIX, which is a measure of implied volatility, tells us how expensive options are. Okay, fair enough. Why do we care? Why does the stock investor care about that? Well, the stock investor cares about that because if these options traders expect more market movement, more ups and downs in the market, it's not necessarily directional, okay? When we just say the VIX is higher, but a lot of time, but options pricing, if it becomes more expensive, the options market is expecting more movement in the market, more volatility, which means, people are a little bit more worried, a little less complacent. In general, however, the higher the VIX is, what we'd say is that's more concern for the market, more fear has built up in the market. Okay. Now, from an options trader standpoint, that could be beneficial or not. Okay. There's pros and cons, and I'm not going to get into it right now, but there's pros and cons. Sometimes options traders like a higher implied volatility environment. Sometimes options traders like a lower implied volatility environment. But the VIX is something, even if you're just a stock trader and don't have an interest in options, it may be something you should be familiar with because you'll hear it referred to quite often on, financial news. The VIX is up, meaning fear is up. That's how that works. If you were to graph the VIX versus the say the S&P 500, when the S&P 500 is going down a lot, the VIX is typically going up a lot, and vice versa there. Okay? All right. Let's keep moving on. We have some stocks. We have some stocks in the news here today, and I thought I'd mention some of those stocks that are in the news. Number one, let's take a look at Meta. Okay, so here's Meta, aka Facebook. Not a huge move, but it has been in the news lately. Meta has kind of come to the conclusion, it appears, that they're kind of falling behind in the whole AI space, and they're trying to poach, is that the word? Lure, maybe is another word. Some top AI researchers from other companies to come over, offering very, very lucrative compensation packages in an effort to kind of up their AI game, so to speak. So in the news, Meta has brought over two additional AI researchers from OpenAI. OpenAI is a Microsoft-backed company. And so they're fairly aggressive in this stance right now, trying to catch up, because it seems right now that's the name of the game. And so not really affecting this stock right now. Overall, fairly bullish. Overall, what you'd have to say is, remember I was talking about flag patterns? Flag pull back. This is kind of a gappy flag pull in a sense. And then a flag pull back, flag pull, breakout, flag pull. So what are some traders looking at for a potential entry here? You could draw a line, is one way that people will approach flags. Take a line from the high like that and say, I want to break above there. Or you could look a break above potential resistance. This was a high before. We actually pierced above that intraday at least a couple weeks ago and look for a break above there. And some traders will even just look at what we often call like a hold. In other words, a close above the high of the low day. Let me zoom in just to kind of illustrate this. In other words, when it pulls back, you identify the low day, which is right here. The low of this day is lower than any others of late, the last few. And you take the high of that day and we look for a break above that as a potential entry. So there's different potential entries there in that, but the traditional flag entry is you draw your flagpole like that, your flag like that, your flagpole like that, and wait for the breakout right in there as an entry. That's kind of the approach that a lot of people do. Now, Paul said something in the chat. I love you. Some of your comments, your chats today are on spot right here today, everybody. Paul said this: the market takes the stocks take stairs up. These are, in other words, think of these as steps up, up and down, up. But they take the elevator shaft down. Have you noticed that? A lot of times, it'll kind of take the slow road up, but when the market turns south, it goes down pretty quick, which is one reason why a lot of traders will kind of put in some measures to try and help protect yourself. You can use stop losses. Stop losses don't guarantee, but let's just say we were in Meta and we were worried that this were going to go down, and you put a stop in down wherever, I don't know, below 700, say. And Meta goes down. Well, if Meta kind of goes down fast, but not gap down, maybe it stops us out close to where our stop is. What if Meta comes out with some terrible news overnight or something, and it gaps down to 640 overnight? Is our stop at 700 going to protect us on that? Probably not likely. We'll probably end up getting out around where the gaps opens the next morning in that case. So stops are not guaranteed, but that's the concern there on that. So that's the news on Meta. Let's talk about some other couple of companies here in the news here today. Amazon. Did you guys buy anything on Amazon Prime Day? I'll tell you, the Moore's household actually did. We bought a few things there. I've got 3 daughters, and they're all kind of have their own things they want, and so. But Amazon announced Prime Day 2025 was the biggest Prime Day event ever. And so, I don't know. Right now, it's, hey, kind of the same story on a lot of these stocks. I could draw flags here. We have the trend going up above that 20-day moving average. The stock's not, overly impressive right now, given the news, maybe kind of expected, but it is better, up about 0.5%. See what the overall market's doing right now. Down a smidge, the overall market. So Amazon is doing okay there. So and Trading Growth said it was Prime Week. Yeah, it was four full days of Prime Day. Is four full days there on that. Okay, let's talk about another stock that's in the news that you guys are all familiar with, and that is Tesla. Okay. So Elon Musk, who has also founded XAI, okay, getting back to the AI theme, said that rumors that the AI company, that is XAI, is seeking a $200 billion valuation in its next funding round are false. Furthermore, he says he does not support a merger between Tesla and XAI. So again, not seemingly to affect the stock that much, but I'd like to bring you up to date with the news because, hey, the news is something you're going to hear. You may hear reference to that through the rest of the week here. Let's take a look at sectors and just see how sectors are kicking off the day here. Sector performance for today, energy down a little bit here. So down about 1%. Sometimes that's driven by oil, sometimes not. Oil's down off a little bit today. You can see the general trajectory of oil's been going up there, though. Okay, so energy has been the underperformer for the day. By the way, this second column I have right here is monthly returns. So this is how it's done for the month. If you want these columns, the monthly return column, by the way, what you can do, or the daily return column, let me just show you real quick on this. If you click on the gear, so you bring up a watch list, of course, and you can do the same thing, by the way, on the Market Watch tab if you go to quotes, okay? You click on the gear, and it's going to ask you to customize, okay? And you can customize more columns here on that Market Watch, the quotes page. That's the advantage of this Market Watch quotes page, is you can get a lot more info shoved in there. The advantage of the watch list over here is it's easy if you link the two. I have orange 7 on both. And I just click, I can see the graph right here. Okay, so there are pros and cons to both. So you have less real estate over here. But if you do want to add those columns, what you can do is just click on the gear, click on customize, and it gives you a bunch of choices. The very top one is percentage change. That's today's change, percentage change. The next one is percentage change since. If you do the percentage change since, what it's going to do is it says like, it may say like 5-day there or something like that, I think. Okay. So it'll look like that. If you click on this, then you can change it to other items there. So I just did a month, and we're going to go a month, click on OK. And so there's my percentage change 1 month there. So anyway, that's what I have. So energy, IT, underperforming today a little bit. Materials, what's doing better today? Utilities, real estate, communications. So no massive. The only one more than a 1% move right now is energy. Not necessarily a huge move day, though, on the markets. Over the last month, what have been the last best performing sectors? Information technology, industrials, financials. All of these have done pretty well. Discretionary, materials, communications. A couple laggards, healthcare, consumer staples there. Okay? All right. So there we go. I think we're just about out of time here, folks. Let me just mention real quick some companies with upgrades today. MasterCard had an upgrade from Seaport Research. PayPal had an upgrade, up 3.5% from Seaport Research. Downgrades. Best Buy had a downgrade, down about 2.5% right now from Piper Sandler. CrowdStrike, these are just kind of bigger names I'm calling out, had a downgrade from Morgan Stanley. All right. There you go, everybody. I think we're going to hold it there. Mr. Michael Fairborn, thank you very much for helping me out. Make sure, by the way, you check out Mike's market and sector analysis webcast on Wednesdays. Wednesdays, 3 o'clock Eastern time. Great webcast. Trying to kind of look at the overall market, how different sectors. I did kind of a quick look at sectors today, but really, if you want more in-depth, important information on sectors, check out that market and sector analysis, 3 o'clock Eastern time on Wednesdays. Thank you very much for joining me, everybody. Hope you have a great week ahead. We'll see what those economic numbers look like the CPI and the PPI, how that affects the market, how our earnings season affects the market. Thanks for joining me, and we'll see you all same time next week. Bye-bye, everybody.